Inflation is up, interest rates are up, the stock market is down. Those fixed deposits or FDs are starting to look really attractive, right? Hold that thought. Hey, how's it going? Welcome back to my channel. This is Pradeep and you're watching Vlog of Note. In this video, we're going to be talking about 3 Government of India backed stock market investments which actually give you better returns than a fixed deposit. Let's get started. So first of all, usual disclaimer here, I'm not a SEBI registered expert or an advisor. I'm not even a certified financial planner. I'm just a person who has made a reasonable amount of money by investing in the stock market. Any investment that I talk about are investments that I have personally made. Before you make any investments into the stock market, you should consult an expert and you should do your own market research. Now that we've got that out of the way, let's talk about these golden investments and let's talk about why we need them in the first place. Now, first of all, I think everyone in this room understands the fact that inflation is just way out of control at this current point of time. In India right now, we have about 7.4% inflation. Basically, what that means is if you were able to buy a product or a service at 100 Indian rupees last year, you would have to pay 107 rupees this year. Now, inflation obviously varies based on your lifestyle. For example, if you have a large home EMI, the interest rates are going up and therefore your inflation for you is actually much higher, so good for you. But I think generally everyone can agree that inflation is out of control. The RBI or the Central Bank of India only has one tool, just like the Fed and the Bank of England, to raise interest rates to fight inflation. Now, this is a blunt tool and the effects of this tool will only be felt probably next year. Basically, the Bank of England raised interest rates by 0.75%, something that they haven't done in over 33 years. All the banks all around the world are raising interest rates except Turkey, who slashed their interest rates from 19% to 10% and their inflation is at 84%. Speaking of interest rates, because banks are raising interest rates, banks are making more money and therefore they're able to offer, or they should be able to offer you, higher rates on your fixed deposits. If you make a fixed deposit in a bank in India right now, in a reputable bank, you should be technically able to earn at least 7.5% on your money. So if inflation is at 7.4%, interest rates are at 7.5% on your FD, then you're technically not making too much money. However, at least there is some protection of capital. In this scenario, you might be wondering, should I make an investment in the stock market? And I think the beauty of investment is that you can technically do both. You can invest in an FD and have that protection of capital, but you can also invest some money into the stock market and get your cake and eat it in the form of dividends. Now, speaking of dividends, Indian stocks generally have a higher dividend yield when compared to the US stocks. Now, why is this so? Well, it could be because of the fact that there is a difference between dividend yield and dividend payout ratio. If a stock is trading at 100 rupees and it has a 12% dividend yield, that means you're going to get 12 rupees as dividend. However, if the stock has a face value of 10 rupees and it gives you a 12 rupees dividend, then the dividend payout ratio, which a lot of media houses use to trick you, is basically 120%. Indian stocks have been listed because India itself has been a free country only for 75 years for much lesser time than the US stocks, and that could be one of the reasons why the dividend yield is so high here. Also, you have the Government of India, which is still a big player in the Indian stock market, providing security to Indian investors. Speaking of security, before we get into this video, I would really appreciate it if you could give this video a thumbs up. It provides me security as a YouTuber. Now let's jump into the video. The first stock on our list is REC or REC, formerly known as Rural Electrification Corporation. This is a PSU or a public sector undertaking, and basically they lend money or provide finance to central and state energy companies in India. For example, the state in which I live, Tamil Nadu, has an electricity board which receives financing from REC. Now, REC had a pretty solid Q2 in my opinion. Basically, their profit went up by 1.6%, which in this economy is actually pretty good, and their revenue went up by 25%. If you look at this company's fair market value, it's currently trading 62% below its fair market value, so you do have the potential for capital appreciation. Also, this company has a dividend yield of 12.5%. So if you were to invest 100 rupees, you would basically get 12.5 rupees back in terms of dividend, which is better than an FD. The second stock on our list is SAIL, or Steel Authority of India Limited. I've already made a video about this company. I do own shares in this company. It's a PSU, or a public sector undertaking, and they are a steel maker. In fact, they are the 20th largest steel maker in the world. I like this company in terms of its moat and its management. Now, unfortunately, because this is India, although we were supposed to get Q2 results, Q2 FY23, Q2, I'll remind you, in India is actually July to September of calendar year 2022. We were supposed to get them on October 30th, but unfortunately, they are not widely available as of now. But we do have Q1 results. In Q1, rather unfortunately, the profit of SAIL went down by 79%. That isn't a typo, but their revenue went up by 16%. For a company with the size and scale of SAIL, I think that's an impressive achievement, and I think Q2 will be a little bit better. If you take this company's PE ratio, or price to earnings ratio, it's at about 3x compared to the others of 22x. So this company has scope for capital appreciation, and if you take their dividend yield, it's at about 10.8%. So if you were to invest 100 rupees into this company, you would get 10.8 rupees back in terms of dividend, and that's still better than an FD. The third company on our list is IOC, or Indian Oil Corporation, not to be confused with the International Olympic Committee. Now, IOC is also a public sector undertaking, or a PSU, and it controls more than half of the oil market in India. Now, that's a moat. We do have Q2 results for IOC, and their profit isn't that good. Basically, they declared a loss of 272 crores versus a profit of 6,360 crores in the last year. Now, that isn't a typo. However, this is because the company is not being allowed to sell their products at a proper price, because the Indian government doesn't want to lose votes. If people find out that the price of petrol and diesel has gone up above 100 rupees at the pump, people will be annoyed. However, their revenue did go up at about 34%. If you consider the fact that IOC is one of the largest companies in the world, a 34% jump in revenue is still very impressive. If you take a look at their PE ratio, it's at about 8x versus 22x in comparison. So this company has a high capital appreciation potential. And if you take a look at their dividend yield, it's at about 12.2%. So basically, if you were to invest 100 Indian rupees into this company, you would get 12.2 rupees back as dividend, and that is better than an FD. Overall, these are three investments which are, in my opinion, better than a fixed deposit. The elephant in the room here is, of course, the government of India, which is a major shareholder and providing security to investors in these companies. If you have any other investments which are, in your opinion, better than these, please do drop them in the comment section down below. As always, please go over to YouTube, subscribe to the Blog of Note channel, ring that notification bell so that you never miss a video, and I will see you guys in the next episode.